Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Ideanomics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Ideanomics operates in two segments, mobility and fintech. Its mobility segment is made up of several electric vehicle brands. One of its companies is Medici Motor Works. Medici sells its own vehicles in the US, Latin America, and Europe. Currently, that company is working with Chinese manufacturers to design and build trucks, buses, and closed area vehicles for mining, airports, and seaports. Another company Ideanomics owns is Treeletrik, which is located in Malaysia. It sells EV bikes, scooters, and batteries throughout Southeast Asia. Ideanomics imports Treeletrik EV bikes into the US. Idex owns 24% of Solectrac. Solectrac is a company that develops, assembles, and distributes 100% battery-powered electric tractors. Idex also owns 100% of Wave. Wave is a provider of wireless charging solutions for medium and heavy-duty EVs. Another company Ideanomics owns is Energica. They own 70% of that company. That company is an Italian electric motorcycle manufacturer that also has developed proprietary EV battery and DC fast charging applications. Ideanomics recently acquired 100% of VIA Motors for $630 million. VIA Motors is an electric vehicle development and manufacturing company founded in 2010. It started out converting GM vehicles into plug-in hybrids, but now produces fully electric commercial vehicles for fleet managers. VIA is developing its own skateboard platform for Class 3 through 5 commercial vehicles that will be available in 2023. They also acquired 100% of US Hybrid, which specializes in the design and manufacturing of components for medium and heavy-duty municipality vehicles, as well as commercial trucks, buses, and specialty vehicles throughout the world. The company's fintech division is called Ideanomics Capital. In January 2021, it acquired 100% of Timios, a nationwide title and escrow service provider for real estate transactions. Idex is headquartered in New York, New York, and was founded in 2004. It trades on the Nasdaq and London Stock Exchange. Let's get started with the model. This is a small cap company, 702 million market cap. They're trading at $141 a share, and they have 498 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every year. Revenue is the sales for the company, and that was $99 million in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales, and the reason their revenue was so high in 2018 was because they were a totally different business back then. They've pivoted a couple of times, and now their new business is mainly focused on EVs, and that's grown from 45 million to 99 million. Below that is their cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. Below that is their operating expenses, and these are all the costs not directly tied to making the product or service. Then below that is their operating income, which was positive in 2019, negative in the other years. Below that is the interest they pay in their debt, and it looks like it's gone down from 16 million to 3 million. And the bottom line of the income statement is their net income, which is negative every single year. This is the company's income statement from the latest 10Q, and this shows us the first 9 months of 2020 versus the first 9 months of 2021. And this gives us a little more detail than Yahoo Finance. Their revenue went up from 16 million to 88 million. Here's a breakdown of their revenue by country. 65,000 from Malaysia. That's from their subsidiary Treeletrik. They're located in Malaysia. They sell EV scooters. 70 million in the US and 18 million in China. Their US sales went up 70 times from 1 million to 70 million. And here's a breakdown of their revenue by product or service. Electric vehicles is 18 million. Batteries is 7 million. Title and escrow services is 62 million. That's all from their subsidiary Timios. Last year they had $5 million of sales from ICE cars. This year it's zero. They had $22 million of revenue from products. The expenses directly related to making those products is $21 million, so not much margin. Their margins are a lot better from Timios, $65 million of revenue, $42 million of expenses. So they do have positive gross profit and went up a lot from $1 million to $25 million. Let's look at their expenses. SG&A went from $20 million to $54 million. SG&A are expenses of the day-to-day operations. This includes salary for support functions, like the CEO's salary, accounting, IT. It also includes rent and insurance, as well as advertising and promotional items. Their R&D expenses went down from $1.3 million to $400,000. R&D is mainly human capital when people try to figure out ways to improve their existing products or come up with new ones. And part of R&D can be payroll, depreciation, or amortization. R&D is expensed as incurred, so it goes straight to the income statement. It's not capitalized, carried on the balance sheet, and depreciated or amortized over time. Their professional fees went from $8 million to $22 million. Professional fees are mainly legal fees. They could include other fees, but in this case, it's all legal fees. And this was connected to their acquisition of VIA Motors. Last year, they had impairments of $10 million. This year, it's $21 million. This impairment is related to cost method. Cost method is a type of accounting. They reported a $7 million gain on Treeletrik. Since this is the expense section, a negative is a positive. So Idex revised the value of Treeletrik on their balance sheet, and they increased it $7 million. So that's why they had to pass through a gain. So this negative $7 million brings down their operating expenses. So it improves their net income. They passed through a $5 million litigation settlement. Back in 2019, someone sued the officers of the company for misstating their financials for 2017 and 2018. So Idex had to pay this party $5 million. And they had $4.4 million in depreciation or amortization. So last year they had a $37 million operational loss. This year it's a $75 million loss. Last year they paid $14 million in interest on their debt. This year it's only $871,000. They sold one of their subsidiaries, Grapevine, and passed through a $1.4 million loss. Grapevine is part of their fintech division. So I think the company's really trying to focus on their EV division and trim down the fintech part of their business. They revised the value of their solectrac subsidiary. After they bought out the remaining shares of solectrac, they revised up $2.9 million on the value of that company on their balance sheet. They had a gain of $300,000 on the extinguishment of debt, and a gain of $689,000 other income. Since they have a pre-tax loss, they're receiving a $9.7 million tax credit, and they're passing through a $1.5 million loss on their equity investments. So they had a net loss of $65 million compared to $48 million the prior period last year. If Idex owns less than 20% of another company, it's probably going to use cash accounting, which means it will only report the dividends it receives from that company. If they own 20% to 50% of another company, they'll use equity method accounting, which means they'll report the company's net income or net loss onto their income statement. If they own above 50% of another company, then they consolidate that company's financials into theirs. So everything on that company's financials will go onto theirs. That company's revenue, that company's expenses, everything. So that's why it has revenue on its balance sheet. Idex doesn't make any products or provide any services. They just own companies that do that. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They leak the most money in the trailing 12 months at $62 million. They spend a little bit in CapEx each year, $1.8 million in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And of course, that's negative every year. The way they're able to fund their business is with debt and equity. They issued $191 million of equity in 2020. When a company issues common stock, it dilutes the current shareholders and makes your shares less valuable. And they added $250 million of debt in the trailing 12 months. They did pay down $97 million. It appears they added that debt to acquire other companies, because in their investing cash flow section, there's a cash outflow of $195 million. This is their cash flow from operations section in their most recent 10Q. The first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with your net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. They had a net loss of $65 million. We have to add back stock-based compensation, that was $19 million. We have to add back depreciation of $4.4 million. The income statement reported a tax credit of $10 million. We have to reverse that out in the statement of cash flows. They passed through a loss of $1.4 million. This is from the sale of some of their subsidiaries. We have to add that back on the statement of cash flows. Then there's the $1.5 million loss on equity method accounting. We have to add that back. Impairments are a non-cash item. They passed through a $21 million impairment loss. We have to add that back. They had a cash inflow of $5 million on accounts receivables. So some of their subsidiaries extended credit in the past. And in this reporting period, there's a cash inflow of $5 million. So customers are paying for the product or service they received in the past. $16 million cash outflow on prepaid expenses. When a company pays for a product or service before they receive it, they book that onto the balance sheet as an asset. But once they receive the product or service, then they take it off the balance sheet and put it onto the income statement as an expense. An example is if you paid your rent upfront for the year. So say your rent was $1,000 a month. If you gave your landlord $12,000 upfront, that's an asset on the balance sheet, and every month you would remove $1,000 from that asset and book it as an expense onto the income statement. It looks like they used accounts payable in the past, and now they're paying for it in this reporting period. So it's a cash outflow of $1.6 million, a cash inflow of $1.3 million on deferred revenue. If someone paid me for a product or service before they received it, I cannot book that revenue to my income statement until I sent them the product or provided them the service. But I have to book it as a liability on the balance sheet. A good example is a Starbucks gift card. If I bought a $100 Starbucks gift card, I would give Starbucks $100, but I didn't receive anything yet. I didn't receive any coffee. So Starbucks has to add $100 to their cash. They cannot add another asset to their balance sheet because assets have to equal liabilities plus equity. So they have to book $100 to the liability section as deferred revenue. That's the best liability to have. Some people think Starbucks' balance sheet is not good, but they don't realize they have so many billions of dollars in deferred revenue because of all the gift cards people pay for in advance. Say I used a gift card all in one shot. I bought coffee for me and some of my friends. Starbucks already received the cash when I initially bought the card. When I actually used the card, Starbucks would have to remove $100 from deferred revenue and then pass through the revenue onto their income statement. Some people get confused why it's initially booked as a liability, because if people are paying you for money up front, it should be an asset. But the only reason it's booked as a liability is because you have to increase your cash and you can't double count your assets. The balance sheet always has to balance. They had a $7 million cash inflow from accrued expenses. Sometimes this is listed as accrued liability or accrued expenses. This is a liability that builds up over time, and then once the company pays for the liability, then it's moved on to the income statement. Say for instance you had a company and you paid employees on the first of each month. Throughout the entire month, you're accruing liabilities because those employees are working for you, but you're not paying them anything until the first. Even though they reported a loss of $65 million, they actually lost $42 million of cash flow. This is their cash flow from investing and cash flow from financing section. The top line of the investing section is purchases of property, plant, and equipment, and that was $1.4 million. It looks like they lent another company money, so they're receiving $464,000 from that note. They had a $44,000 cash outflow from the disposal of some of their subsidiaries. They acquired $101 million in other companies. I couldn't back into this number. I'm sure if I spent more time, I could piece it together. And they spent $32 million on long-term investments. They break down to $35.5 million in their report, $10.5 million in non-marketable equity investments, $25 million in equity investments. Non-marketable equity investments are just investments in private companies. They mentioned that right here. I pulled all this information from their quarterly report. The private company they invested in is Treeletrik Electronics Automotive. This is a German company. It manufactures and distributes components for automotive, energy, and electronics. They invested 7.5 million euros for 11,175 preferred shares, and that's equivalent to $8.5 million. So I'm not sure how they got 10.5 million. Maybe the value of this investment is 10.5 million, or maybe there's other companies in addition to this they didn't mention in the report. The 25 million are investments in public companies. And here's a breakdown of the 5 companies. And here's the 25 million. Half of it is in the Italian company Energica. Then FNL Technologies is 3.5 million, 8 million in TM2. That's Timios, the title and escrow company. And they invested 58 million in debt securities. So they had a cash outflow of 192 million in their investing section. Last year it was only $500,000. They raised 220 million from issuing convertible debt, and they raised 185 million from selling options, warrants, and common stock. So it looks like some of the convertible debt matured, so they had to pay that investor $80 million. Most companies don't want to pay convertible debt. The ideal situation is a stock price goes up a lot, so that debt converts to equity. But Idex's stock price didn't go up enough for that debt to convert to equity. So they had to pay the investor the original principal balance of $80 million. So they had a cash inflow of 325 million from their financing section. Last year was 46 million. This is the equity section of their 9/30/2021 balance sheet. They have 529 million of equity. They raised 938 million from selling their business, and they lost 400 million from running their business. Let's look at the capital structure. They have 529 million of equity, 9 million of debt. They're 98% equity, 2% debt. And they have a lot of cash on their balance sheet. Their net debt is negative 306 million. And I gave them the lowest whack on Finbox, 7.2%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 678 million. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $502 million. We divide that by 498 million shares. And we get a calculated stock price of $1.01. They're trading at 141, so they're trading at a 40% premium. It's a sell, according to the model. The average analyst projects their revenue to grow 37%. To get their future revenue estimates, I grew at 37% for the next 4 years. And to get their future free cash flows, I needed to figure out what percent of their revenue they would convert to free cash flow. I can't do that because their free cash flow is negative. I looked at other companies in their industry, and the average company converts 9% of their revenue to free cash flow. So to get their future free cash flows for 23 and 24, I multiplied their revenue by 9%. And I figured they would have negative free cash flow through 2022. So it's really hard to value this company because it can go many different ways. I have a fairly structured system for valuing companies. So this company probably wouldn't work too well in my system since they don't have positive free cash flow and they're still in growth mode. So the stock price for a company like this is really based off of supply and demand of the market. If investors feel the future of this company is going to be really strong, they may push the price up to $5, $10, $20 a share. But if there's a lot of concern about their future, the stock price can go lower. It's really anyone's guess at this point, but if you feel really good about this company and what they're doing, then I would just buy the stock and hold, because it's at a really low value right now, under 1 billion market cap. The stock was really low a year ago, and then there was a ton of buying activity. I think there was a short squeeze and the stock got up to over $5. If you bought the stock close to their low point and sold close to the high point, you could have 30 or 40x your money. There was some companies shorting this stock, so they put out a lot of negative press about the company. They were questioning the legitimacy of their subsidiaries, so that negative press hurt the stock. And as you can see, it's gone down a ton since its peak. They have a negative beta, so the stock moves opposite the market. It's gone down 37% in the past 52 weeks, while the S&P is up 23%. The 52-week low was $1.26, the high was $5.53, and the stock is trading well below its 50-day and 200-day moving average. And there's lots of trading activity on this stock. Over 10 million shares are traded each day. Of the 498 million shares outstanding, 492 million are on float. When a share is on float, that means it's available for people like me and you to purchase. So the 6 million shares not on float cannot be purchased by the public. 15% of the shares are held by institutions and almost 9% of the shares are shorted. A bullish sign is a company that's adding employees. They're currently at 110. There's been minimal insider trading activity. A couple months ago, the founder and CEO sold 250,000 shares at 206. So he's probably pretty happy right now. The public owns 86% of the stock, institutions 13%, and insiders 1.2%. BlackRock is the biggest shareholder at 4.5%. They own 22 million shares. State Street is 1.6%. The CEO is 1%. DE Shaw and Susquehanna. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is a bit high at 7.1. Price to sales is stock price over sales per share. Or it's simply market cap over revenue. So that means investors are paying $7 for $1 revenue. Their price to book is really good at 1.3, much better than the market median and average. Price to book is stock price over book value per share. And book value per share is equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities. And they have 529 million of equity, 343 million of tangible equity, since they have 186 million of intangibles on their balance sheet. A company gets intangibles on its balance sheet when they acquire another company. They have a high current ratio of 8, a high quick ratio of 7.9. They have $250 million of cash on their balance sheet, 58 million of available for sale securities. Available for sale securities can be debt or equity the company plans to sell. Inventory of 3.8 million and 23 million of prepaid expenses. So it seems like the company has a good amount of money to get through the next couple of years without raising any more debt or equity. They had negative 64 million of free cash flow in the trailing 12 months, and they have 312 million of working capital. Working capital is current assets minus current liabilities. So they have $248 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 2 other companies in the same industry as Idex. And if Idex has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They're worse in PE and price to sales, but they have a good balance sheet. They have a good price to book ratio, a really high current ratio, negative ROE since they have negative earnings. They are really low in debt, and they're a tiny company under 1 billion market cap. So to summarize, I have them trading at a 40% premium. Penny stocks can make you a ton of money, or you can lose a ton of money. They're very volatile and risky, but if you do your homework and find a really good one, you can be set for life. It seems like this company is pretty active growing their business. They're doing lots of acquisitions. And if they can get a portfolio of many EV companies, ideally the subsidiaries of Ideanomics can all help each other, which will benefit Idex's shares immensely. That's really the goal of focusing on a particular industry. They're also doing fintech, which is where most of their revenue comes from. But I think focusing on electric vehicles and the entire EV market will probably be their best chance to grow and become a really profitable entity. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.